They told you this was about safety, about stopping missiles, about protecting allies. But what if the war was never the point? What if the missiles, the strikes, the chaos were just the distraction, while something far bigger, far more valuable, was quietly being moved into position? Iran sits on one of the largest oil reserves on the planet, and right now, a senior White House official has just confirmed Washington is considering taking control of it, not sanctioning it, not blocking it, owning it, the refineries, the pipelines, the export terminals, all of it. This isn't just a war anymore. This is the biggest resource grab in modern history, and it has already begun. Welcome to Currency Archive. Now, before we go any further, I want to ask you something, and I mean this with full respect. If you are over 50 years old, you have lived through enough history to know that when governments start talking about stabilizing energy supplies, someone somewhere is about to get very rich. You've seen this before, and deep down, you already know what this means. So do me a favor. If this channel gives you the kind of honest, no-nonsense analysis that the mainstream won't touch, hit that subscribe button. Think of it as leaving something real behind for the next generation, something true in a world full of noise. And one more thing, where are you watching from today? Drop your city, your country, right there in the comments. Because this story affects every single one of you, differently depending on where you live. Let's get into it. Every major war in modern history has had two stories. The first story is the one that appears on television screens. It is loud, dramatic, and filled with images of missiles, military convoys, and politicians making urgent statements. It is designed to be watched. It is designed to be believed. The second story is quieter. It moves through boardrooms, energy terminals, and diplomatic back channels. It does not make headlines. It does not need to. By the time the public understands it, the decisions have already been made. The conflict between the United States and Iran is no different. For months, the world has watched the situation escalate through the lens of military confrontation. Strikes, counterstrikes, naval movements, and regional alliances have dominated the coverage. Analysts have debated missile ranges. Journalists have tracked troop deployments. Governments have issued travel warnings and emergency statements. But while the world was watching the fire, someone was already moving toward the vault. It did not arrive with fanfare. It was not delivered as a declaration of war or a dramatic press conference moment. A senior White House official, speaking with the measured confidence of someone who already knows the outcome, indicated that Washington is now considering taking control of Iran's oil infrastructure, not destroying it, not sanctioning it from a distance, taking control of it. The distinction matters enormously. When a government destroys infrastructure, it removes an asset from the board. When it takes control of infrastructure, it inherits the asset. It inherits the revenue. It inherits the leverage. This single statement, buried beneath layers of military reporting, represents one of the most significant economic announcements of the modern era. And yet, most of the world's population processed it as a footnote. Another development in an already complex conflict. That is not an accident. To understand why this moment has been underreported, one must understand how modern conflict narratives are constructed. When governments prepare to move on a major strategic asset, they do not announce the economic objective first. They build a security justification. They establish a threat. They create a context in which intervention appears not only reasonable but necessary. In the case of Iran, that justification has been under construction for decades. The nuclear program, the proxy networks, the regional aggression, each of these elements is real. Each of them is also useful. Useful is the visible story that keeps the public focused on danger, while the invisible story focuses on opportunity. History has seen this pattern before. In the early 20th century, the scramble for Middle Eastern oil was conducted under the language of colonial administration and regional stability. In the 1950s, the overthrow of Iran's own democratically elected Prime Minister Mohammad Mossadegh was framed as a Cold War security operation. The real trigger was his decision to nationalize Iran's oil industry, threatening the interests of British and American energy companies. The language changes across generations. The logic does not. When the White House official referenced key refineries, pipelines, and export terminals along the Persian Gulf, they were not speaking in abstractions. They were describing a specific, physical, and extraordinarily valuable network of infrastructure that processes and moves a significant portion of Iran's daily oil output. They were describing the mechanism through which Iran finances its government, funds its military, and maintains its position as a regional power. Control that mechanism, and the economic equation of the entire conflict changes instantly. This is not speculation. This is the stated intention of a senior official within the most powerful government on earth. And for the business community, for entrepreneurs, investors, and anyone there's a number that very few people outside of energy boardrooms and government intelligence briefings ever hear spoken out loud. That number is trillion, not billion, not a few hundred billion, trillion. That is the scale of what sits beneath Iranian soil, flows through Iranian pipelines, and moves through Iranian export terminals into the global energy system every single day. And yet, when most people think about Iran, they think about politics. They think about conflict. They think about nuclear negotiations and regional tensions. They do not think about what Iran actually is at its economic core. Iran is not simply a country in conflict. Iran is one of the most asset-rich energy states on the planet, and the infrastructure that extracts, refines, and exports that wealth is now sitting directly in the crosshairs of the most powerful economic and military machine in human history. What is actually on the table? When the White House official referenced Iran's oil infrastructure, 3 specific categories of assets were being described. Each one is distinct, each one is irreplaceable, and together they form an economic system that has kept an entire nation, under severe international sanctions, under decades of pressure, still standing. The first category is refineries. Iran operates some of the most sophisticated refining capacity in the Middle East. These are not simple processing facilities. They are industrial ecosystems, employing tens of thousands, converting raw crude into usable fuel products, and feeding both domestic consumption and international export pipelines. The Abadan refinery alone carries a history stretching back over a century, representing one of the oldest and most strategically significant refining operations in the world. The second category is pipelines. Iran's pipeline network is the circulatory system of its economy. Spanning thousands of kilometers, these pipelines connect oil fields in the southwest to refineries in the interior, and from there to export terminals along the coast. They move crude oil, natural gas, and refined products simultaneously across a nation the size of Western Europe. Disrupting them would not simply reduce output, it would collapse the entire distribution architecture of the Iranian energy system overnight. The third category is export terminals along the Persian Gulf. This is where the global dimension becomes impossible to ignore. Iran's export terminals, particularly those positioned along the Persian Gulf, are the points at which Iranian oil enters the international market. These terminals handle the loading, processing, and dispatch of oil shipments bound for refineries across Asia, Europe, and beyond. They are the final gate between Iranian energy production and global energy consumption. Control these 3 categories simultaneously, and one does not simply weaken Iran. One owns the tap. The reserve question. Beneath all of this infrastructure lies something even more significant: the reserves themselves. Iran holds the 4th largest proven oil reserves in the world. Estimates place this figure at approximately 210 billion barrels. To place that in context, that is enough oil, at current global consumption rates, to supply the entire planet's demand for nearly 6 years without a single additional barrel from any other source. This is not a marginal energy asset. This is a generational one. And unlike many oil-producing nations where reserves are aging or declining, Iran's hydrocarbon infrastructure remains significantly underdeveloped relative to its true capacity. Decades of sanctions have prevented the foreign investment and technological partnerships that would have otherwise accelerated extraction and modernization. What this means, in practical terms, is that whoever gains operational control of Iran's energy sector does not simply inherit what exists today. They inherit the potential of what it could become. The post-conflict model, being discussed behind closed doors, policy discussions have already moved beyond the question of whether to act, and toward the question of how to structure what comes after. The models being referenced are not new. They draw from post-conflict resource governance frameworks applied in other regions, international oversight bodies, cooperative management structures, production sharing agreements that distribute operational control among allied stakeholders while maintaining the appearance of sovereign administration. In simpler terms, the infrastructure remains on Iranian soil, but the decisions about what it produces, where it goes, and who profits move somewhere else entirely. For the global business community, this restructuring, if it proceeds, would represent the single largest forced transfer of energy asset control since the nationalization era of the mid-20th century. The question is no longer whether this changes the world. There's a moment in every major geopolitical shift when the consequences stop being theoretical, when they stop being something analysts debate in conference rooms and start being something ordinary people feel in their electricity bills, their fuel costs, their grocery prices, and their business margins. That moment for this particular shift is not coming. It is already here. And the world, distracted by the military theater of the conflict itself, has not yet fully processed what is moving beneath the surface of the global energy system right now. Because what happens when one of the world's largest oil-producing nations loses operational control of its own infrastructure is not simply a regional story. It is a story that begins in the Persian Gulf and ends on every continent on Earth. The market already knows. Global oil markets do not wait for official announcements. They do not wait for peace agreements, press conferences, or congressional approvals. They move on information, and sometimes, more dangerously, on the anticipation of information. The moment the White House official statement entered circulation, energy traders began recalculating. Prices fluctuated, positions shifted, risk assessments were quietly rewritten behind closed doors at some of the world's largest energy trading desks. This was not panic. It was something more precise than panic. It was recognition. The people who move markets for a living understood immediately what the general public had not yet absorbed, that a statement about taking control of Iran's oil infrastructure is not a military threat. It is an economic declaration. And economic declarations of this magnitude do not leave markets unchanged. They restructure them. The fluctuations seen in the immediate aftermath of that statement are not the story, they are the preview. The full story, the sustained structural repricing of global energy, begins when the dust of the conflict settles and the new operational reality becomes permanent. Asia's exposure, the continent that cannot look away. Of all the regions watching this situation unfold, none has more at stake than Asia. China, India, Japan, and South Korea, 4 of the world's largest economies, share one critical vulnerability. They are all heavily dependent on Middle Eastern oil to sustain their industrial output, their transportation networks, and their long-term economic growth trajectories. For China, the implications go far beyond energy supply. Beijing has spent the better part of 2 decades constructing an alternative economic architecture, one designed specifically to reduce its dependence on systems controlled or influenced by Washington. The Belt and Road Initiative, the expansion of the yuan in international trade settlement, the deepening of energy partnerships with Iran, Russia, and Gulf states, all of it has been built with one strategic objective in mind: to ensure that no single power can hold a chokehold over China's economic lifeline. The prospect of American-aligned forces controlling Iran's oil infrastructure does not simply threaten China's energy supply. It threatens the entire strategic logic of the last 20 years of Chinese foreign policy. It places Washington's hand directly on one of Beijing's most critical supply arteries. This is not something China's leadership will absorb quietly. For India, the calculation is different but equally serious. India has carefully maintained strategic autonomy, purchasing Iranian oil even under sanctions through creative financial arrangements, balancing relationships with both Washington and Tehran to protect its own energy security. A fundamental restructuring of Iranian oil governance forces India into a choice it has deliberately avoided making for years: side with the new order and accept terms set by Washington, or resist and risk the consequences. For Japan and South Korea, the exposure is more straightforward but no less significant. Both nations are among the world's largest energy importers, and both have economies built on the assumption of stable, accessible Middle Eastern supply. Any disruption to that supply, whether through conflict, infrastructure damage, or a fundamental change in who controls the output, translates directly into manufacturing costs, consumer prices, and GDP contraction. 4 of Asia's most powerful economies, 4 different vulnerabilities, one common source of exposure: the OPEC dimension. The consequences do not stop at Asia's borders. Within the Gulf itself, other major oil-producing nations are watching this situation with a level of attention that goes far beyond diplomatic concern. Saudi Arabia, the UAE, Kuwait, the core OPEC producers, understand something that outside observers frequently miss. The restructuring of Iran's energy sector under external control does not only affect Iran, it sets a precedent. It demonstrates, in real time and with real assets, that a sufficiently powerful external actor can move on a nation's sovereign energy infrastructure under the cover of conflict, restructure it, internationalize it, and redirect its output, without triggering the kind of unified global resistance that would have made such a move impossible in previous decades. Every OPEC member watching this unfold is performing the same quiet calculation. If it happened to Iran, what does that mean for us? The answer to that question is already reshaping behind-the-scenes diplomatic conversations across the Gulf. It is already influencing production decisions, alliance recalibrations, and the quiet acceleration of sovereign wealth diversification strategies among nations that have, until now, felt relatively secure in the protection of their own resource sovereignty. The dollar's silent victory. There's one final dimension to the global domino effect that the business community cannot afford to overlook. For years, one of the most consequential and least publicly discussed geopolitical trends has been the gradual movement among major economies away from settling oil trends. There is a particular kind of silence that falls over serious decision makers when they realize that what they assumed was background noise was actually the most important signal in the room. That silence is happening right now, in boardrooms and trading floors, in the offices of entrepreneurs and investors who have been watching this conflict unfold through the lens of geopolitical drama, rather than through the lens of what it actually is: a structural economic shift, one of the most significant in a generation. And the businesses, investors, and capital allocators who fail to read it correctly, who continue treating this as a military story rather than an economic one, will not simply miss an opportunity. They will walk directly into consequences they never saw coming. What history teaches about resource control shifts. This is not the first time in modern history that a major resource control shift has occurred under the cover of conflict. And history, for those willing to study it carefully, is remarkably consistent in what it reveals about what happens next. When the post-World War II energy order was established, when American and British energy interests carved up Middle Eastern oil production through a series of agreements, concessions, and political arrangements, the consequences for global commodity markets were not immediate. They were structural. They unfolded over years, reshaping shipping lanes, refinery economics, petrochemical supply chains, and the energy cost assumptions built into virtually every major industrial economy on Earth. When the Soviet Union collapsed and its vast energy infrastructure was restructured, rapidly, chaotically, and under enormous external pressure, commodity markets experienced a decade of volatility that destroyed businesses which had failed to anticipate it and created extraordinary wealth for those who had. The pattern is consistent across every major resource control transition in modern economic history. In the immediate aftermath, uncertainty and volatility. In the medium term, structural repricing across entire supply chains. In the long term, a new order with new winners and new losers, distributed according to who understood what was happening while it was still happening. That window, the window of understanding while it is still happening, is precisely where the world sits today. The sectors that cannot ignore this. For the business community, the implications of an American-aligned takeover of Iran's oil infrastructure are not abstract. They are sector-specific, measurable, and in several cases already beginning to manifest. Shipping and logistics face the most immediate exposure. Iran's position along the Persian Gulf places it adjacent to the Strait of Hormuz, the narrow waterway through which approximately 20% of the world's traded oil passes every single day. Any disruption to the operational status of that corridor or any fundamental change in who controls the energy assets feeding into it translates directly into shipping route recalculations, insurance premium spikes, and freight cost increases that cascade through global supply chains within weeks, not months. Petrochemicals and refining face a deeper, more structural challenge. The global petrochemical industry is built on assumptions about feedstock costs, supply origin, and processing geography. A fundamental restructuring of Iranian refining capacity, whether through damage, external control, or post-conflict reorganization, disrupts those assumptions at their foundation. Businesses that source petrochemical inputs without accounting for this disruption are operating on a model that may no longer reflect reality. Energy-intensive manufacturing, steel, aluminium, cement, glass, fertilizers, faces a cost structure recalibration that few CFOs have yet built into their forward projections. When energy markets reprice structurally, not temporarily, but structurally, the businesses that survive are those that identified the shift early and adjusted their cost models before the market forced them to. Small and mid-sized businesses dependent on stable fuel costs face perhaps the most underappreciated risk of all. Large corporations have hedging desks, derivative strategies, and financial buffers that allow them to absorb energy price volatility for extended periods. Small and mid-sized operators frequently do not. For a logistics company running thin margins on fuel costs, or a manufacturer whose energy bill represents 30% of operating expenses, a sustained structural increase in energy prices is not an inconvenience. It is an existential threat. The investment signal, hidden in plain sight. For entrepreneurs and capital allocators willing to think beyond the immediate noise, this moment contains something rare. It contains clarity, not the false clarity of certainty. No one can predict exactly how this situation resolves, or on what timeline, but the genuine clarity of direction, the kind of directional signal that serious investors recognize as the foundation of asymmetric opportunity. The direction is this: the global energy order is being restructured. The restructuring is being driven by the most powerful economic and military actor on the planet. It targets one of the world's largest proven reserve bases, and it will, regardless of how the specific details resolve, produce a sustained period of energy, market repricing, supply chain disruption, and geopolitical realignment. Within that environment, certain asset classes, sectors, and geographic positions become structurally more valuable. Domestic energy production in non-conflict regions becomes more strategically significant. Alternative energy infrastructure, not as an ideological choice, but as a supply security hedge, becomes a harder economic argument to dismiss. Commodities with historical relationships to energy price movements deserve serious reconsideration in portfolio construction. And perhaps, most importantly, cash flow visibility becomes the single most valuable business characteristic in an environment of structural uncertainty. Businesses that know exactly where their revenue comes from, exactly what their cost base looks like, and exactly how much runway they have under adverse conditions are not simply better managed. They are the businesses that survive restructuring cycles, while their less prepared competitors do not. The 3 decisions. Serious decision makers must make now. History does not reward the most intelligent observers of major economic shifts. It rewards the ones who translated observation into action while the window was still open. For the business community watching this situation unfold, 3 decisions cannot be deferred. The first decision is an honest assessment of energy exposure. Every business that operates with fuel costs, energy-intensive inputs, or supply chains touching the Middle Eastern corridor must conduct a clear-eyed analysis of what a sustained 30, 40, or 50% increase in energy costs would do to their operating model, not as a worst-case scenario exercise, as a planning baseline. The second decision is a supply chain audit. Businesses that source materials, components, or finished goods through supply chains with significant exposure to Asian manufacturing hubs, particularly those dependent on Middle Eastern energy inputs, must understand where their vulnerabilities sit before the disruption arrives, not after. The third decision is a positioning review. For investors and capital allocators, the question is not whether to react to this situation. It is whether current portfolio construction reflects the structural reality of an energy order in transition. The businesses and asset classes positioned for a stable, predictable energy environment are not the same ones positioned for the environment that is now taking shape. The war will eventually end. The cameras will eventually move on to the next crisis. The headlines will eventually find a new story to tell. But the restructuring of Iran's oil infrastructure,